Well, as we've been talking about, the euro surging this morning after ECB President Jean-Claude Trichet said interest rates could rise as early as next month. Joining me now is John Taylor. He's the chairman, CEO, and founder of FX Concepts. John runs the world's biggest currency hedge fund, somebody you really want to listen to when we're talking about the euro and the dollar, of course. But first off, I know longer term you see that the euro is going to weaken, but what do you make of this move today?
Well, I think that this is Trichet at his best, right, where he is very, very aggressive at following his orders. And basically he lives in Frankfurt. He's thinking about how strong the German economy is and how strong the French economy is. And he is acting on inflationary threats, which is what the ECB always does. Right.
So they're on their mandate of basically inflation watch, right? And this is what you're seeing. This is exactly the reflection that you're seeing right now.
Right.
So where does that leave the euro then?
Well, that leaves the euro going up because, at least momentarily, because interest rate spreads are very, very important in currency valuation, and the dollar interest rates are not going anywhere, and European rates are going up.
For how long, John?
Well, that's a good question. Trichet did this before in July of 2008. It was an utter disaster. They raised their interest rates 25 basis points right before the crisis came in the fall. And that put the European banks in a bad spot. I think he's doing the same thing.
Right, because you actually see that the global economy is slowing down and that there could be perhaps another recession here in the U.S., but overall slowing growth around the world.
Right, exactly. And some of that growth that's slowing is slowing more in Europe than anywhere else.
Then what do you expect if, in fact, this turns out to be more than just a 25 basis point hike, but it is something in a series of interest rate hikes? Where does that leave, then, the growth picture in Europe? What happens there?
Well, it leaves them in a big problem because all of Germany's growth is export-driven. And if you make the euro go up, then Germany's going to be at a competitive disadvantage with the United States, with China, with Japan. And that's going to hurt Germany.
Okay, so then, John, at what point does the euro peak? What are you looking for peak euro?
Well, certainly, price-wise, maybe 145. Time-wise, by June.
By June?
Yeah.
Why do you say by June?
Well, because our cycles and things say that, and we see a slowing in the European economy and the U.S. economy already. So everybody's going to say, what's Europe doing with this high price? It's going to kill them, and so the euro will just fade away on its own.
Okay, and by June, where do you see the Fed?
I see the Fed exactly where it is now.
Okay. Right. At what point, though, do you think that the Fed could turn and start raising their own rates?
Well, if the economy holds up, which is not my belief, but if it holds up and the Fed raises rates, it'll raise it at the end of the third quarter. And that would cause the stock market to go down, and I believe would cause a recession to come anyway. It would be very similar to what happened in 1994 when the Fed raised rates after a long period of no rate hikes. All of a sudden, the bond market got clubbed, and Bill Gross could then be right? Nobody would want to buy bonds.
Right.
And we went into a slowdown. Only in 1994 was only a minor slowdown, but I think this time it'll be a real recession.
So if I've got your view right, John, then what you're saying is that the Fed could likely raise rates in the third quarter of this year because the economy is doing better, but that's just only going to slip us into a further recession. Right. That's what you're saying?
Yes. I'm afraid I'm a one-track person, right? We're going into a recession, damn it. That's it.
and there's no stopping it.
Right. No, there really is no stopping it.
And John, right before the break, we're talking about recession. And your belief that your firmer belief that we are falling into a second round of a recession here. To outline for me exactly why you are so sure about this.
Well, because if you look at what's happened with the Fed's activity in putting all the money in the QE2 in the market, and then the government making a deal, the Republicans and Democrats making a deal to keep the Bush tax cuts alive and everything, that money is keeping the consumer in the market. But if you look at where the money is going, in fact, more of it's going into savings and not so much of it is going to the market, at least looking at the January numbers. Now, maybe the snow goofed them up. We don't know for sure. Mm-hmm. But the fact is that when the QE2 gets pulled away from the market, we believe that there will be higher interest rates, more pressure, and the consumers won't be there anymore.
But you are seeing some good economic numbers, though, right?
Absolutely. The numbers are excellent right now. There's no doubt about it.
So why dismiss those, though?
Oh, I don't dismiss those. Things are great.
Okay.
Now, we should all be happy now.
But
However, by the fall, it's not good. I mean, this year I've said was a 4-3-2-1. 4% in the first quarter, 3% in the second, 2 in the third, 1 in the fourth. By the time the fourth comes, everybody will be scurrying around saying, geez, we're going to a recession.
So, John, let's tie that and the currency market and the stock market together.
Right.
Before the break, you were talking to Betty about how a stronger euro is no good for Germany.
Right.
The DAX, the German stock market, has had a better run than the S&P over the last year, and you not too long ago made some headlines for your bearish views on the German stock market for the next 12 months. What about the U.S. stock market? I mean, do you think that...
I think the U.S. stock market looks very good relative to the DAX. In fact, I'm rather surprised that the DAX is up as much as it is today. Part of that, I think, is, at least my people tell me, is because of a rumor that Gaddafi has made a deal with Chavez and other people and is going to leave Libya. And that's helped the markets globally.
But you like the U.S. stock market?
Coming back to the U.S.
U.S. stock market is much better. And for the reasons that you were mentioning before, the trade is going to be improved from the United States point of view a lot.
Right, but you had said earlier that there will be a correction here. There will be a time when the stock markets, they'll fall.
Right. Right. Well, maybe we just had that little correction. I do think there will be more wobbling and everything, but the stock market is likely to continue up for another couple of months.
Okay, but then there will be the correction.
Yeah, no, I mean, there is a recession coming, and part of that is just the normal economic reality of things, right? You go up and you go down, and we have gone up with a lot of government stimulus.
Okay.
Republicans don't like that stimulus. Obama doesn't like it.
John, thank you very much for staying around. John Taylor of FX Concepts.